MRF stock has grown by 79% in the last 3 years, rising from around 73,000 to over 1,31,000 rupees. Sounds tempting, right? But look at it this way. Buying just one share costs over a lakh. Now imagine if MRF slashed the price of each share to 1/10, that is to around 13,000 rupees. Suddenly owning a share feels much more affordable. The tire manufacturer can achieve this with a stock split. Sounds amazing, doesn't it? And no, MRF is not splitting its shares. We wish they were. Hello and welcome to our channel 5 Minute Finance by ET Money, where we discuss the basics of investing and personal finance. In this video, we'll discuss in detail what a stock split is and how it impacts the investors. We'll also cover how stock split differs from a bonus issue, as they both result in increasing number of shares and reducing the share price. So what is a stock split? A stock split happens when a company divides its shares into smaller units. This reduces the price per share but does not change the overall value of your holdings. It's like cutting a cake into smaller pieces. Each piece is smaller, but the total cake size stays the same. Remember, it is a split. No new shares are issued, but since the same shares are being split in a certain ratio, the face value also gets split in the same ratio. Now, face value is the value of stocks listed in its books and share certificate. It remains fixed and is decided at the time of issue unless there is a stock split. Now let's understand with an example. So take Nestle India. Earlier this year, Nestle India Limited announced a 1:10 stock split. This meant that one Nestle India share with a face value of 10 rupees was subdivided into 10 shares with a face value of 1 rupee each. This move made Nestle India India's 6th highest priced stock more affordable. Now, before the split, its share price was 27,150. Post-split, the share price dropped to 2,715 rupees, making it more accessible to small investors and boosting trading volumes. Companies do this to make shares more affordable and attractive to new investors. Coming to bonus issue of shares. So, bonus shares are like getting an extra slice of cake without paying for it. These are extra shares a company gives to its existing shareholders for free. But the total value of your investment remains the same. The stock price is adjusted according to the bonus ratio. Now, don't mistake it for a correction or a fall in stock price. Let's understand with an example. Take Reliance India that made a bonus issue earlier this year. Suppose you had 100 shares of Reliance at the rate of 2,600 each. So, the total value of your investments was 2,60,000. The company decided a bonus issue of 1:1, meaning for every one share you hold, you would get one additional share. Now, after the bonus issue, you would have 200 shares at 1,300 each, and the total value remains the same at 2,60,000. Now, listen to this carefully. I said earlier in the bonus issue that you should not mistake it as a fall or correction in share price. Then, where do these extra shares come from? Well, these are issued to the existing investors out of companies' reserves. Reserves are profits that the company set aside for specific purposes. You can find reserves in the balance sheet of a company. So I hope you would have the basic idea about stock split and bonus issue of shares. Now let me take you through the basic differences between the two. Number 1, purpose. A stock split lowers the share price to make it more affordable for new investors. Bonus shares reward existing shareholders without cash payouts. Now, a bonus issue is considered as an alternative by many companies to dividends. In dividends, a company gives out extra money to shareholders from its net profits. In a bonus issue, the shareholders are given extra shares. Number 2, impact on face value. Stock splits reduce the face value of a share proportionally to the split ratio. In the case of bonus issue, there is no change in the face value. Number 3, attracting investors. Stock splits attract new investors due to lower prices, while bonus shares focus on rewarding existing ones. So to sum it up, bonus issues and stock splits both increase the number of shares and reduce share prices, making them more accessible. They differ in impact on face value and company reserves. What's your take on these strategies? Let us know in the comments.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.